All right, so today what we're going to do is we're going to focus on building out the first part of the model where we will forecast 11 years worth of income statement and balance sheets and therefore 11 years of economic statement data for a company. And we're going to use Coca Cola, ticker symbol KO, as our example. Right? So what I'm about to show you, I've already done, but I'm just going to illustrate it as a process that you'll need to do because this is a reusable model if you were to use this model for a different company. So basically the first three tabs of the spreadsheet model, valuation model, KO start, are data IS, data BS, and data CF, right? That is just historical income statement, balance sheet, and cash flow data that is coming from Bloomberg Professional, which we're using as our common data source for companies because they give us data in a standardized format. So in this case, what I'm going to do is go to Bloomberg very quickly. And in Bloomberg, if I go to Coke, KO US Equity, then the section of Bloomberg that we're going to use is called Financial Analysis. FA is the short code. And this is where we can get the historical standardized data for a company. It is organized by tab. So in this case, we're going to use the data from the income statement tab for our income statement in the standardized format. So what we would do is we go to the historical income statement data that Bloomberg has for a company. We would click on Output and dump it to Excel. So on the machines in the lab where Excel is loaded as a plugin, it will then load the data into Excel. Now, very important, every time that Bloomberg dumps data into Excel, it will flag a Microsoft security warning, right? Because the data that's coming in is a format that's a data export format, and Microsoft will warn you it's a security risk. And this is very important because every time you export from Bloomberg, you will have to say yes to this pop-up to say it's okay to import the data into Excel. Otherwise, everything will just freeze. So if you hit export and nothing happens, most likely this menu could be hidden behind several screens. So look for the security warning. And you have to say yes every single time. So say yes. It will then load the data into Excel. And again, the reason why there's a security warning is it's not actually sending numbers. It's sending data lookup codes. So essentially, if I were to save this file and leave the Bloomberg lab, then when I reopened the file, Excel's going to go try and find the Bloomberg database. It won't be on the machine I'm on, and it'll just give me a bunch of errors. So very important next step is that since you won't have Bloomberg on your local computers, what you'll need to do is select the whole tab by clicking the upper left-hand corner, right-click, copy, right-click, paste special, values. And what that will do is it will overwrite all of the fields with numbers. So instead of database lookups, I now have numbers. Now when I leave the lab, I can basically open up the file without a problem, and I will always have these numbers. Right? So the trade-off is that if I actually had Bloomberg on my computer, then I could open up the file and Bloomberg would always refresh the most current data. But I have to have Bloomberg on the same computer as Excel. If I don't have Bloomberg on the computer, then it's going to give me errors. That's why we're converting it to numbers. But because they're numbers, I will never have the most current data. I'll only have the data at the time. So this is the extra step that we're taking in this process since you guys don't have data, Bloomberg loaded on each of your machines.
We do that for every tab.
But we'll need to do that for each of the tabs. The other thing that's going to be very important is that when Bloomberg doesn't have a number in its database, when it exports it as not available. And the code that Bloomberg lists is #NA space N/A. And that means not available. So we're going to treat not availables as zeros. And the reason why is that in formulas, Excel chokes on NAs in formulas. All right, so if you use a formula and you refer to an Excel field that says NA in it, it'll just give you an error in your formula. So we have to get rid of the NAs. So we're going to use the find command, the find replace command, which is Control F, which is find. And then we're going to look for the pound n/a space n/a. We're going to hit replace with zeros, and we're going to replace them all. So now I have a file which doesn't have the NAs and which has numbers. All right, and then I'm going to save this file, File, Save As, an Excel workbook, and I'm going to call this KOIS for ticker symbol dash income statement. Save, and I already did this the last class, so replace. So now I have a copy of this on my hard drive. I'm going to go through the same process in Bloomberg with the balance sheet. So again, output to Excel, and with the cash flow statement. Output to Excel, making sure that I'm outputting the standardized data. Okay, so that's the process that I'm going to do. Now, what I had done previously to the start of this class is I had posted those outputs to Canvas. All right, so yesterday I did this process for those 3 statements, and I put those 3 files into Canvas. Those are these 3 files right here. The income statement data, the balance sheet data, and the cash flow data, following the exact same process. And then this is the starting file that we're going to use. Our next step to update the model, and again, I've already done this step for the model that you're using today, just showing you the process, is to go back to Excel. And then what I'm going to do is I'm going to open up the income statement file that I just exported. I'm going to select the whole thing. I'm going to copy the whole thing. And then in my Data IS tab, I'm going to select the whole thing in my model, right-click, Paste Special Values. And that would have updated my model with the most recent data that I just imported from Bloomberg. Okay? So this is how we're going to make it a reusable model. Because we're using a standardized format in Bloomberg, we're basically able to, row by row, overwrite the data with the most recent data. So I could actually switch this from Coke to Pepsi, or Coke to Walmart, or McDonald's, or Ford, or whoever. And so basically, that's the process that you'll do for your group projects, right? And for some upcoming homework assignments. But as I said, you don't have to do that for today. I've already done this step. So where we are picking up in the model is we've exported the most recent data for Coca Cola as of yesterday. I've put it into the first 3 tabs of our model, and we now have the historical data for Coke in our model, right, from using the Bloomberg standardized format. Those are the first 3 tabs. So what we're going to try and accomplish today is to then forecast 11 years worth of financial statements. So we now have the historical data in there. We're going to forecast. So one of the tabs in the model, they go from left to right, is called the income tab. Right? Now, in the Data IS tab, I have the historical income statement data for Coke. In the income tab, what I've done is I've just pulled out the relevant income statement fields. There's more data than that in the actual tab. And I've just put it into sort of reverse order so the oldest field is on the left, because the Bloomberg standard format is the oldest field is actually on the right. Right? So I've kind of transposed the numbers for us. But the other reason why I've done this tab, and there's 2 important reasons, is we're going to use this tab for forecasting. So this tab will have both the historical data on it, and it will have the forecast data on it. So we're going to make the forecast in just a minute to the right on this tab. Okay? So there's historical Coke data, and this will be forecast Coke data. Right? That's what we're about to forecast. The other reason that I recreate the income tab is you'll notice that I'm using a bunch of relative references. And what I'm actually doing is I'm trying to see that using the data that I just exported, if I can get to the same net income as the data that I just exported from my data source. Before we started using Bloomberg Professional, we used to use Thomson Reuters in this class, Thomson 1, and as a data service, it just sucks. It's horrible. And the reason why I find it to be horrible is because it doesn't add up. Like you export financial data and you add them together and you don't get the actual balance sheet of the company, or it doesn't match the company's statements that they put in their 10Ks. And so Thomson 1 I find to be completely worthless as a data source. And that's one of the reasons why we're embracing Bloomberg. Capital IQ is also pretty good. But that's why I do not advocate using Thomson 1. Where Bloomberg, I still try and foot just because of the horrible experiences we've had in the past with Thomson Reuters. And basically, Bloomberg, I've yet to catch them making a mistake. So I'm not saying that they're not fallible like everybody else, but they tend to put more effort into making sure their statements are accurate and reflective of what the company actually publishes. So it's still good practice to make sure that if you recreate statements, that they add up. Because the last thing you want to do is be in front of a company with statements that don't add up or have incorrect data. You'll lose all credibility with that company immediately. So back to this. What we've done is I've done this for the income statement and I've done this for the balance sheet. This is the historical income statement and the balance sheet data. Now, what I've also done in the model to make your lives a little bit easier is there's a tab called TFI where on your midterm exam, you had to create the TFI. I've done it for you. And I've done it by mapping it to the Bloomberg standardized fields. So this is a correctly reorganized TFI on the historical data. This is a correctly reorganized TII and a correctly reorganized CFI. And what's nice is this is all relative references. So therefore, every time I update my data, then all of these statements will update as well. Okay? So again, what we're trying to build here, and this is very important, the idea of a reusable model. One that we can replicate again and again and again, okay, as opposed to a one-off model. So therefore, we have to be very careful about hard coding in numbers, right? Because if we hard code in numbers, it's harder to reuse the model. That's going to be a very important principle as we go through this process. So the process that we're about to go through involves using the ratios tab as our starting point. As McKinsey discussed in our reading for this week, a best practice for forecasting financial statements is to not forecast the statements directly, but rather to forecast the ratios. All right, so I don't forecast revenue, I don't forecast cost of goods sold. What I do is I forecast ratios, and then I use those ratios to create forecasted statements. That will get me a better forecast. So what I've done here, and that's why I said this becomes a very important tab, the ratios tab, is I've created a tab that gets me historical ratios, historical income statement ratios, and historical balance sheet ratios. And then I'm going to use these historical ratios to help me guide my forecast of ratios. But on this tab, I'm also going to put in my forecast. And then it's the forecasted ratios which will create the forecasted statements. So let's start out with the forecast. Again, very important to use relative references. So on the ratios tab in cell H1, the first forecast year for Coke would be 2014. So equals previous year plus 1. That would be the first forecasted year. Now, the first ratio is the revenue growth rate, where we can see that in 2013, Coke shrank by negative 2.4%. So what I'm going to do is say equals previous year. The other thing I'm going to do, because we're going to build a very complex model with a lot of cells in it, is I'm going to use the color yellow to highlight cells that I can change, as opposed to cells that are not yellow are cells that I don't want to change. Right? So later when we do what if or manipulation to our spreadsheet, I don't want to break formulas, especially with all the relative references. So anything that's not highlighted with a color, I don't want to change because it's going to probably break my model. So you can choose whatever color you want. I choose yellow, but again, highlight which cells you can change, which cells you cannot change. All right? Yes?
Are you saying it's hard-coded? Like, there's just a number in that cell?
Well, what I'm saying is right now, I'm saying equals the previous year, right? because I'm going to just start out as a placeholder by saying revenue is just going to keep growing at the same rate, shrinking 2%. But later, I think next week, when we continue doing the valuation of Coke, I might come up with a different revenue growth rate. So I'll know, oh, this is a revenue growth rate I could change as opposed to a historical revenue growth rate, which I don't want to overwrite that cell by mistake. Okay. So back to this. So just to give you a preview of what we're about to do, let's go to the Income tab. And I'm now going to label the forecast to differentiate from the historical data on the Income Statement tab. And again, relative reference equal previous year plus 1. So I'm not going to type in 2014. I'm going to use a relative reference. So again, if the dates ever change, my model automatically adjusts. And here's the thing. I have the revenue growth rate. The formula for revenue growth rate is last year times 1 plus the growth rate. So in this case, for 2014 equals the 2013 revenue times left paren 1 plus from the ratios tab 2014 revenue growth rate, right paren. And I'm going to go ahead and format this entire column as currency to 1 decimal place, just to match the rest of the formatting. So what I've basically done very quickly is if Coke keeps shrinking at 2%, then this would be the revenue for next year. Right? Now, as we're building out the model, I'm just going to leave whatever they've done historically as a placeholder. But eventually, what we're going to be able to do, so don't do this right now, I'm just going to show this as an illustration, but what if Coke grew at 4%? Then dynamically the model will change. Okay, that's what we'll eventually be able to do once we finish the model. But right now, we're setting up the model to be able to do that. So we can do that what-if analysis. Yes? Not the 4% one. Yeah, I understand. So basically what I did is I just took off the Income tab G3, which was 2013's revenue, and I multiplied by 1 plus out the Ratios tab H2, which was the percentage change in revenue for 2014 that I'm forecasting. All right. The next line item down is cost of revenue. So again, I'll go back to the Ratios tab, and for 2014 equals the previous year, cost of revenue. And again, I'm going to make that yellow because that's something that I could change. And then the same idea. And by the way, you can see on the Income tab, the formulas, the pluses and the minuses over here that we're going to be following. So for cost of revenue, which is what Bloomberg calls cost of goods sold, okay, they call it cost of revenue. So in this case, equals 2014 newly forecasted revenue times, from the Ratios tab, 2014 cost of revenue as a percentage of sales. So 16,045.7. So if they have the same cost of goods sold percentage, this would be the dollars of that cost of goods sold, called cost of revenue. Right? Now, the next line item down is called gross profit. So here's what we know about gross profit. Gross profit is revenue minus cost of revenue. So since I've forecasted cost of revenue, it doesn't really make sense to forecast gross profit separately because revenue minus cost of revenue equals gross profit. So what I'll do is I'll solve for the gross profit. So in this case, equals revenue minus cost of revenue, and that is my forecast for gross profit. Now this is a subtle but very important point. I'm making a conscious choice on whether or not I forecast the component or the result. The component is cost of revenue. The result is gross profit. I forecast one of the two, I solve for the other. I have chosen to forecast cost of revenue and solve for gross profit. You could have chosen to forecast gross profit and solve for cost of revenue, right? But you can't forecast both independently because they're tied to each other, okay? So I'm just saying in the model that we're building, we're forecasting components to solve for results. Therefore, we're going to forecast cost of revenue, operating expenses, which are SG&A, depreciation and amortization, and that's going to give us gross profit, EBITDA, and operating income, also known as EBIT. Okay? So essentially, we're going to forecast the components that will get us those results. That's what we're going to do as a process. So I'm going to go back to my ratios and apply the same rule. Since we've basically solved for gross profit as a percentage, it's 100% of revenue minus cost of revenue, so equals 1 minus cost of revenue. That is my gross profit as a percentage. Notice I'm leaving this one without color, and the reason why I'm leaving this as a white cell is because I don't want to change it later, because it's dependent on the yellow cell above. And that's why I'm using color in the model to distinguish things that I can change versus things that I don't want to change later, because I'll mess up my model. Right? Next, I'm going to finish off the ratios first, then we're going to go back and complete the income statement. We would forecast operating expenses. So for now, placeholder equals the previous year. I'm going to make that yellow. EBITDA equals gross profit minus operating expenses as a percentage of revenue. So EBITDA is not yellow. Right? To get to my operating income, I forecast my depreciation and amortization, which for now is my previous year. Again, I'll make that yellow, something I could change in the future. My operating income equals EBITDA minus the DA. And I very quickly forecasted the operating income as a percentage for Coca Cola. Now, tax rate, I need to come up with a representative tax rate for Coke on a go-forward basis. And as I look at the last 6 years, with the one exception of 2010, most of their tax rates have been in the mid-20s, but 2010, even as an outlier, doesn't seem like it's that much of an outlier. So what I'm going to do is I'm going to use the average function in Excel and take an average of the last 6 years' tax rates. And to me, that seems like a reasonable tax rate for Coke, 22.3% on a go-forward basis. But that is a cell that I'm going to make yellow because it is a number that I might choose to change at a later date. Right? So again, to come up with a representative rate, I'm going to start out with a presumption that the average of the last 6 years seems like a reasonable rate for Coke on a go-forward basis. If for some reason they had some big outliers, then I probably wouldn't use an average rate. Like let's say a company paid 0 taxes 1 year or paid a huge amount of taxes because they were paying deferred taxes 1 year, then an average rate may not make sense for the 6 years. But for Coke, it seems like a reasonable assumption to make. Okay? All right, no plat. We know by definition that no plat or no pat is operating income times 1 minus the tax rate. So in this case, we can solve for that. Equals operating income times, left paren, 1 minus the tax rate, right paren. That will get us our no plat. And non-operating gains and losses equals previous year, make that yellow. So I have quickly forecasted the income statement, ratios. Now what we just need to do is fill in the rest of the income statement itself. So I'm going to go back to the income tab. We're forecasting the 2014 income statement and continue on with our forecast. Operating expenses, also known as SG&A, equals 2014 revenue times, from the ratios tab, 2014 operating expenses as a percentage of revenue. EBITDA equals gross profit minus operating expenses. That would be our forecast for EBITDA. Next, depreciation as a percentage of revenue equals 2014 revenue times, from the ratios tab, 2014 depreciation and amortization as a percentage of revenue. It's the 1929.1. So operating income equals EBITDA minus DA. So we've quickly forecasted operating income. Questions about anything so far? Yes.
Cost of revenue. What was that one again?
So cost of revenue would have been 2014 revenue times ratios H3, which would have been the cost of revenue as a percentage of revenue for 2014. Yes. So same principle. For operating expenses, it would be the 2014 forecasted revenue times ratios H5, which is operating expenses as a percentage of revenue for 2014, out the ratios tab. Okay. All right. One of the things that was discussed in the book for the reading that you guys did this week was how basically we're assuming in an enterprise DCF valuation a target capital structure, which means we're not going to really play around with debt and equity in the future for the firm. So if we're not going to play around with the debt and equity, we don't have to worry about playing around with the forecast interest expense. What you'll find is the forward interest expense actually has no impact on the valuation anyways, but leaving the interest expense unchanged at least gives us essentially this idea of a constant capital structure. So what we're going to do for interest expense equals the previous year. Whatever interest they're paying, they're going to keep paying because we're going to leave the debt alone. Next, FX, foreign exchange gains and losses. Most companies today manage, if they have foreign currency, to basically hedge to get those gains and losses as close to zero as possible. It's hard to forecast, so we're not going to try to do that. So again, we're just going to make that zero. If you want to go and make assumptions different than what we've put in the model, you're welcome to, but I'm saying it's a lot of work for not much impact on your valuation. Right? So the impact of foreign exchange gains and losses is going to be pretty negligible to our valuation here. So put that as a zero. Non-operating gains and losses equals 2014 revenue times, from the ratios tab, 2014 net operating losses and gains. Pre-tax income. You can see that I'm now following these formulas on the left. So equals operating income minus those three items. Minus interest, minus FX, minus non-operating losses or gains. So 11,187.8. Now, if that were our pre-tax income, we'd look at our tax rate to figure out how much taxes we would pay. So equals pre-tax income times ratios, 2014 tax rate. So our income before extraordinary items equals pre-tax income minus taxes. 8690.7. For extraordinary loss, the key word there is extraordinary or extraordinary, basically meaning one time. They shouldn't happen again. So if we have extraordinary losses, they shouldn't recur into the future, so therefore we're not going to predict them in the future, so therefore zero. Minority interest. Since we're assuming a target capital structure, whatever dividend payments they're making to the minority shareholders, they'll continue making to the minority shareholders equal the previous year. Leaving us with net income equals income before extraordinary items minus the extraordinary items minus the minority interest. That would be our net income. The next line item would be, yes?
What is an example of extraordinary?
An extraordinary item or loss might be, let's say we sell an asset and we sell an asset for a loss. So it's a one-time sale. We wouldn't actually, get a recurring gain or loss on it. So we just specialize it. Because the whole point of the income statement is the things above net income should be recurring, and we want to separate out the non-recurring stuff. All right. So total cash preferred dividends. Coke does not have any preferred stocks, so not paying cash dividends for preferred shareholders. But if a company did, because we're using this as a reusable model, whatever dividends they're paying, we're going to let them continue to pay. Okay, so equal the previous year for cash dividends. Other adjustments, 0. Other adjustments are accounting adjustments. So when FASB changes the rules, companies have to restate their financials. When they restate their financials, they make adjustments to income. These are typically non-cash adjustments. So 1, it's hard to predict what those adjustments will be, and 2, they won't affect the valuation. So we're going to leave those as 0. Net income to common shareholders equals, now this is a trick, net income, even though the sign over there says minus preferred dividends, we're going to plus the preferred dividends minus the other adjustments. And the reason why we're doing this is because Bloomberg, on the statement of cash flow, lists dividends as a negative number. So it's going to come in from Bloomberg as a negative number. And if we subtract a negative number, it's going to be like adding it. So on the income statement, they list expenses as positive numbers. On the cash flow statement, they list dividends as negative numbers. That's just a formatting convention that they're using. So just to adjust for that, that's why I'm switching that sign. Net income available to common shareholders. Abnormal gains and losses. Again, same idea. These are things that are non-recurring that shouldn't happen all the time. Now, it is ironic that Coke has had abnormal gains and losses for 6 consecutive years, right? But typically, these shouldn't be recurring. Matter of fact, I would question their accounting practices, because if they're really having this many abnormal gains, these to me start to look operating, okay? But in any event, we're not going to predict abnormal because it's too hard to figure out. So therefore, 0. Normalized income equals net income plus the abnormal gains. Dividends. Common dividends equal the previous year. And this is exactly where you can see the concept that Bloomberg is giving us dividends as a negative number. So the common dividends are showing a negative number. So typically we would subtract the dividends from the normalized income, but in this case we're going to add the negative number. So equals normalized income plus the dividends, and that will give us what's called change in retained earnings. That's how much our retained earnings will go up by. Net income minus dividends. So very quickly, we have just forecasted the income statement for 2014 for Coca Cola. Pause for questions. Yes?
What's the formula for depreciation and amortization?
As a percentage of revenue? So basically, we would take the 2014 revenue, so H3, and multiply it by the ratios, the 2014 depreciation and amortization, which is H7. All right, so since I'm back on the ratios tab, our next step is to take 2014 ratios and copy and paste them out 11 years to 2024. Now, very important, don't drag. All right? Excel tries to seduce you with this drag function. Don't drag in this class. Dragging is bad. And you might say, what do you mean by drag? Well, if I go down here to the bottom, you'll see that I can almost anchor this, click and drag and pull, and it will copy and paste. But sometimes when you click and drag, Microsoft, to be helpful for you, will say, aha, you're trying to create a series, and I will create a series for you, and I won't even tell you that I'm doing it because I'm so good at knowing what you want me to do. Except you didn't want them to do it, and they didn't tell you they did it. And then your model doesn't add up, and you can't figure out why. So what I'm telling you is, in these very complex models, that click and drag, that pulling across, which works 9 out of 10 times, or even 95 out of 100 times, that 5 out of 100 it doesn't work, will make your life miserable. So just don't do it, particularly in this model. So what I would strongly recommend is copy paste. And the shortcut for copy is select something and hit Control-C on a PC or Command-C on a Mac. And then paste is Control-V or Command-V. That is much better than clicking and dragging. Okay? Questions? Saw some hands. All right. So now that we've dragged out the ratios, copied out the ratios, what we're then going to do is on the income tab, we're going to take 2014. Yes? All right, so watch what I'm doing here. So I'm selecting 2014, hold down my mouse till I'm done, and then let my mouse go. So I've selected this range. Then on a PC, I would hit Control-C. On a Mac, I would hit Command-C. So I copy. Or I could just go to the Edit, Copy. That'll also work. And then what I do is I click and drag out to row column R. And then I either Command V or Edit Paste, paste it out. Now, what these pound numbers means is that there's not enough room in the cells to display the data. So if you highlight this range of columns, and then you expand the column width of one of the columns, it'll actually expand the column width of all the columns in the range that you just selected. So I made the columns big enough to hold all the data. But what we have just done in a very short period of time is we have created a forecast for Coca-Cola's income statement through 2024, assuming that those ratios come true. Now, one other adjustment we're going to make to this model. On the Ratios tab, with the tax rate, for 2014, we had used an average tax rate of the previous 6 years. But I don't want to keep using an average tax rate in all the forecast years. Whatever average tax rate I came up with is a representative tax rate for Coke going forward. So therefore, starting in 2015, so I9 in the Ratios tab equals H9. And I'm going to copy what's in I9 and paste it all the way out to R9. So I'm going to use a constant tax rate for the 11 years of forecast. I'm not going to keep doing an average because the average will slightly change every year. Because it will average the average. Okay, so I'm using an average for 2014, and I'm using whatever I did in 2014 for the out years. So if you're following along, the bottom right number on your income tab should be 1711.7. Okay. All right.
You forecast the ratios to what?
2024. So 11 years. And the reason why we're doing 11 years is 10 years will be defined. Year 11 will be the start of the continuing value period. And you remember the book talked about in its reading, you always do T plus 1 years.
So when you copy and paste on the income statement, we're doing just values. Paste.
No, you don't. You just copy and paste here because you want to actually copy the formulas too. So no copy paste values. You actually want to just copy paste.
Okay. And you just copy 2014, right? Or you
Copy 2014 and then paste it all the way across. Yes. Yep. Why do we, I'm sorry? Well, the change in retained earnings is basically going to be what's left after all the adjustments that are made to equity, and that's what we're going to add to our balance sheet retained earnings line item. So the change in retained earnings is basically, like I said, it's net income minus dividends, but if we're making other adjustments to equity, then those adjustments would affect what would be in retained earnings. So rather than doing an AOCI adjustment, we would actually just show the adjustment on the income statement. And as I said, this is what bothers me about accounting principles today, is what the accountants are increasingly doing is they're skipping this step and they're not showing on the income statement these miscellaneous adjustments they make. They're just making them directly to the statement of equity, and they call it an AOCI adjustment, and therefore you can't actually see how your income statement gets to your balance sheet. So what we're kind of forcing our model to do is to tie the income statement and the balance sheet together. It'll just be cleaner for our valuations because we want to have statements that foot. Okay?
So we need to 2024, right?
And we're going to 2024. All right, moving on. We're now going to do the balance sheet. We've just forecasted the income statement. Now we're going to forecast the balance sheet. Similar idea. We're going to start with the ratios. Okay? So we're going to forecast the balance sheet ratios, and the ratios will create the forecast for the balance sheet. Now, we're going to start out with these 9 ratios. Right? Now, I've just chosen these as the 9 ratios that we want to forecast. If you wanted to forecast more of the balance sheet, you obviously could. But there is one place here in this forecast where we're going to diverge a little from the book. So one of the things the book teaches us is that in an ideal forecasting model, we want to tie the balance sheet to the appropriate income statement driver. So what that means is that if I'm forecasting, for example, accounts receivable, I tie it to revenue. But if I'm forecasting inventory, I tie it to cost of goods sold or cost of revenue. Okay? So I ideally want to tie the balance sheet to the appropriate income statement driver. Now, for our purposes, we're going to skip that step and we're going to simplify and we're going to tie all of these balance sheet ratios as a percentage of revenue. Okay? It has 2 advantages for us. One, it's easier, and it really doesn't get you that much different of a forecast than if you'd done it the other way. But number 2, it actually ties it to activity. So the idea is that as revenue grows, the balance sheet will grow. As revenue shrinks, the balance sheet will shrink. So the idea is we're really tying it to cycle time and productivity. And if we leave these ratios constant, what we're really assuming is a constant level of productivity in our balance sheet. So in a way, it will help us with the forecast of gross investment and give us a cleaner gross investment based on an assumed level of productivity. So that's really why we're going to leave it tied as a percentage of revenue. So number 1, I think it's easier, and number 2, for our purposes, it will get us a better valuation and a cleaner valuation forecast without having to make a detailed forecast of the balance sheet. So here's what's going to happen. Take accounts and notes receivable as an example. Equals the previous year. Now, right now, accounts and notes receivable are 10.4%. I could choose to change that later, so I'm going to make that yellow. And I'm just going to do that for the whole equal the previous year for all 9 of these ratios. So all 9 of these ratios equal the previous year. Okay. All right. So I then go to my balance sheet. And just like we did on the income statement, I'm going to start forecasting my balance sheet. So I'm going to label this the forecast to differentiate. Previous year plus 1. Relative reference. I don't want to hard code in 2014. And I'm going to start forecasting the balance sheet items. Actually, the first balance sheet item that's a ratio is not on the ratios tab. It's on the assumptions tab, and it's operating cash as a percentage of revenue. So one of the other things that we're going to do in the model is that when we make these assumptions that we can change, we want to put them in as few places in the model as possible because we don't want to forget where to go to change things. So I'm aggregating all of our changes to 2 tabs. One is the ratios, and anything that's not a ratio that we change is going to be on the assumptions tab. And that will just make our lives easier later so that we're not constantly hunting through the model to remember where we need to change things. Just good practice for building Excel models. So I already have an assumption for operating cash as a percentage of revenue at 2%. And we could theoretically change that later. But essentially, that's what we're going to do is we build out balance sheet ratio number 1. So operating cash in 2014 equals, from the assumptions tab, 2% of revenue, times, from the ratios tab, from the income tab, 2014 expected revenue. And again, I'm going to format this column currency 1 decimal place, just to match the formatting of the previous columns. So 914.4 million. Now, one additional thing about the operating cash forecast, for the ratios, we're going to have ratios that go out 11 years. For the assumptions, we only have one assumption for all 11 years. So if I copy and paste this out, starting in 2015, it's actually going to give me a bunch of zeros. And the reason why is because when I copy and paste it out, it's going to look at assumptions C3, where it's always going to be assumptions B3. So what I have to do for this particular ratio is put in what's called an absolute reference in Excel, which means in this formula, in front of B3, I need to add a $ in front of a B and a $ in front of the 3, which means make an absolute reference, or what used to be called string B, string 3. Okay, back in the Lotus 1, 2, 3 days. But the idea is that we're making this an absolute reference, which means that no matter where we copy and paste, it will always refer to cell B3 of the assumptions tab.
You multiply that by what again?
And I multiplied that by the 2014 revenue, which I'm not making an absolute reference because it's going to be multiplied by the revenue each and every year. All right. The first of the ratios tabs, ratios, are the accounts and notes receivable. So again, for the balance sheet, go to accounts and notes receivable equals ratios, accounts and notes receivable as a percentage of revenue for 2014 times, from the income tab, 2014 expected revenue. Next, inventories equals, from the ratios tab, inventory as a percentage of revenue in 2014 times, from the income tab, 2014 revenue. Other current assets equals, from the ratios tab, other current assets as a percentage of revenue times income 2014 revenue. Next one's long-term investments equals, from the ratios tab, long-term investments as a percentage of revenue times, from the income tab, 2014 expected revenue. The next one down is going to be net fixed assets. That's the next ratio. So, and again, the balance sheet equals, from the ratios, 2014 net fixed assets as a percentage of revenue times, from the income tab, 2014 revenue. The next ratio down now gets to the liabilities. Oh, sorry, forgot other long-term assets. So other long-term assets equals ratios, which was the other long-term assets times income 2014 revenue. Then we go to the liability side to accounts payable equals ratios, accounts payable as a percentage of revenue times, for the income tab, 2014 revenue. Other short-term liabilities equals ratios, other short-term liabilities as a percentage of revenue times income 2014 revenue. And finally, other long-term liabilities equals ratios, other long-term liabilities as a percentage of revenue times income 2014 revenue. Yes.
I think your net fixed assets is in the wrong spot. It's in the blue row.
Thank you for pointing that one out. So let me put that in the just do that one again, be easier. So for net fixed assets equals from the ratios, net fixed assets times 2014 revenue. There you go. Thank you for pointing that out. All right, so very quickly, we have forecasted these 10 balance sheet ratios, the 9 off the ratios tab plus the 1 off the assumptions tab for Coke for 2014. Questions about what we've done? All right, our final step of the balance sheet is to finish creating a balance sheet that balances, and very important, without a circular reference. If you have a circular reference in your model, you have an incorrect model, and therefore a model that's not valid. So we have to get a balance sheet that balances without a circular reference. So I'm going to show you how to do that. So what we're going to do is we're going to finish off the liabilities and equity side of the balance sheet first. So in this case, we'll start out with equity. So I'll start out with preferred equity. Same concept as the income statement. Since we're going to not change the capital structure, whatever preferred stock we're going to leave outstanding. So equals the previous year. For minority interest, whatever is outstanding we leave, equal the previous year. And for share capital and additional paid-in capital, equals the previous year, because we're not going to forecast an issuance of stock. So we're not going to change any of those 3 items. We're just going to leave those alone. The only item that is going to change is the retained earnings. So here's what we know. On the income tab, we had forecasted for 2014 a change in retained earnings. That's how much retained earnings would go up by. So what we're going to do for the balance sheet is we're going to say take 2013 retained earnings and add from the income tab the forecasted 2014 change in retained earnings. And that should become the retained earnings balance at the end of 2014. So equals G32 plus from the income tab H25, which is the change in retained earnings for 2014. Those are the 4 equity accounts, which I could now sum up. And that becomes my total equity. Now, from here, I need to finish off the liabilities. So I'm going to start out with short-term borrowings. Short-term borrowings equals the previous year. We're going to leave any short-term debt outstanding because we left the interest alone. Which means total current liabilities are the sum of the three. I can sum those three up. For long-term borrowings, equal the previous year. Because again, whatever long-term debt they have, we're going to leave outstanding. We're not going to change the long-term debt of the company. Pension liabilities equals the previous year. The assumption we're going to make on pensions is that under U.S. accounting rules, companies are not allowed to have long-term pension deficits. They must fully fund their pensions. So whatever pension liability they have, we'll leave, but we're not going to let it grow over time because it's got to be fully funded. If I add those three items up, I get my total long-term liabilities. If I add my current liabilities and my long-term liabilities, I get my total liabilities. If I add my total liabilities plus my total equity, then I get the total liabilities and equity for the firm. Now, we need a balancing balance sheet. So here's how I'm going to get the balance sheet to balance. I'm going to force it to balance. Assets equals liabilities and equity. Right? Now, in order for the assets to truly balance, that means I've created the concept of what's called a plug, which means I'm going to have to solve for or plug for something in order to get my assets to add up. And the plug on the asset side of the balance sheet is excess cash. So excess cash becomes my plug, right? So what I really need to do is solve for all the other items on the assets, subtract them, and whatever's left gets me my excess cash. So as I look, most of my assets are filled in with a couple of exceptions. First, excess cash. I don't want to put in anything for excess cash because I'm going to solve for that. Next, gross assets, gross fixed assets, and accumulated depreciation. I'm actually not going to solve for those because I've actually solved for net fixed assets. And net fixed assets, or net PP&E, is what we actually care about. And I don't really care about the gross or the accumulated depreciation because I'm going to really care about the net. So I can try and create that, but it's extra work that has no impact on my model, so I'm not going to worry about it. Goodwill equals the previous year. Too hard to forecast acquisitions. So therefore we're not. Whatever goodwill they have, they're going to keep. Because under new accounting rules or newer accounting rules, companies don't write off their goodwill. They only impair it. So technically, goodwill could stay forever. Plus, it's a non-cash item. So we're going to leave the goodwill alone. So these are all the non-summed accounts. So now I'm just left with excess cash. So now I solve for excess cash. So excess cash equals total assets minus everything else. Minus operating cash, minus accounts and notes receivable, minus inventory, minus other current assets, minus long-term investments, minus net fixed assets, minus net goodwill, minus other long-term assets. So that would be our excess cash balance. Yes?
How did you get total assets?
Total assets equals total liabilities and equity. I just set them equal to each other. And notice that when I did that, no circular reference. So if you did this and you have a circular reference, you made a mistake. Questions? Questions? All right, so now I'm just going to fill in the rest of my balance sheet. So total current assets, I can now sum the 4 items above it. Total long-term assets, I can now sum from long-term investments all the way down to other long-term assets. And just as a check, if I add my long-term assets and my total current assets together, then I get the same 93,304.4.
You repeat that again.
Which part?
The last one.
You mean the sum?
Not the total.
So all I'm doing is I'm just as a double check, I'm adding my long-term assets and current assets together just to make sure that I get the same total asset number, which I did. Just make sure I didn't make any mistakes. So essentially, I have a balancing balance sheet with my plug as excess cash. So here's the thing. I told you we needed 11 years of forecasted balance sheets. So here's what we're going to do. We're going to go back to the ratios for the balance sheet. We're going to copy the ratios for the balance sheet forward 10 more years and paste them to 2024. We're then going to go to our balance sheet tab and we're going to take the 2014 balance sheet that we just created. We're going to copy it and we're going to paste that out through 2024. And then to fix the column widths, like I said, if I select all the columns and adjust one of the column widths, it'll adjust them all so that all the data fits. But I now have balancing balance sheets going out to 2024. So very quickly, we've just created a model that forecasts Coke's income statements and balance sheets through 2024. And here's the thing. Don't do this, what I'm about to do. This is what we'll do next week. Don't do this right now. But just as a preview, watch what happens. If I go to the ratios, and instead of negative 2.4%, I forecast 4% revenue starting in 2015. Then the entire income statement adjusts and the entire balance sheet adjusts. And I now have a much bigger balance sheet going forward because I have a whole bunch more excess cash that I otherwise wouldn't have had. So that's the point. We've now built a dynamic model that, and this is key, has relative references so we can do what ifs. But we're not doing what ifs today. We're just setting up the placeholders. That's where we're eventually going to go. For now, we're just leaving these data in as placeholders so we at least start building all the model together. Almost done. Final step. We have 11 years of forecasted income statements and balance sheets. We now need 11 years worth of economic statements. TFI, TII, CFI, economic profit. So I go to the TFI tab. On the TFI tab, TFIs, as I mentioned before, have already been created based on historical data with relative references to the Bloomberg standardized fields. So here's all I need to do. Take column G, copy it, out 11 years. Equals previous year plus 1 for the relative references for the years. And I now have, through 2024, forecasted TFI, which balances. So the forecast of the balance sheet created the forecast of the TFI. TII, same process. I take 2013, I copy it. I paste it out to 2024. Equals previous year plus 1, just so my year labels are correct. Copy, paste to 2024. Make my columns a little bit bigger. But I now have balancing TIIs through 2024 based on my forecasted income statements. CFI, copy 2013 CFI, paste through column R. What's most important is I now have a forecast for CFI and free cash flow through 2024. So really what we've done is we've used the forecasting of the income statements and balance sheets to get us the forecasted free cash flow, which is going to be key to our DCF valuation. That's why we went through this process. All right? So by forecasting the financials, which is easier to do, we're essentially forecasting free cash flow. In fact, I had somebody ask me in Monday's class, why don't we just forecast free cash flow directly? And the answer is you can. You can forecast free cash flow directly and do a DCF that way, but there's no context to that. If your free cash flow goes from $3 billion to $5 billion, what's the context? Like academically, sure, you do an NPV, works out well in Excel, and you got a number. But what did that mean to the company's growth rate? What did it mean to its margins? What did it mean to the types of products and services it's selling and whether or not it could actually achieve that level of sales? That's why it's much more valuable to forecast the financial statements, because that gives us a much more meaningful context to the eventual free cash flows. That's why we've gone through this extra step. But nonetheless, we've tied the two together. So as any of these numbers change, the cash flows change, and therefore the valuation will change. But that's what we've kind of set up as a model. All right. By the way, almost done. We got to do the same thing with economic profit. We got to take the 2013 economic profit based on beginning of year data and copy and paste it out to 2024. Equals previous year plus 1. Make sure the years have relative references that are pasted out. And we need to do it based on end of year economic profit as well. I'm just taking the first cell that was a 0 and taking previous year plus 1, and then just recopy and pasting that out. So, in about an hour, we've now forecasted out 11 years of income statements and balance sheets, tied it to the ratios, and have 5 economic statements forecasted out 11 years. If you have reached this point, save, you're done with homework 5. You could theoretically upload right now, you're done. If you haven't reached this point, you have until Monday at 10 a.m. to reach this point and upload it. This is an individual, not a group assignment. No uploading somebody else's file. That's an honor code violation. So you must do it yourself. Now, this class is being recorded and will be posted on YouTube. So if you want to go back and see anything we've done, the YouTube video should be posted shortly, as soon as we're done and finished here. But this would complete the assignment for today.